You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by MIAX, one of the fastest, most efficient trading platforms in the world. MIAX is proud to bring you Spikes Volatility products. Spikes options and futures are traded on the Spikes Volatility Index, SPIKE, offering pinpoint accuracy, radically faster dissemination, and a highly transparent settlement auction, all for ultra-low exchange fees. It's volatility reimagined. Learn more about Spikes at miaxoptions.com/spikes. Options and futures involve risk and are not suitable for all investors. The statements made are provided for informational purposes only and should not be relied on for financial or legal advice. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you, there are a legion of ways for you folks to get access to the content, pretty much on every device under the sun on the on-demand side. There are literally more in my inbox today looking to add ours. It's amazing how many new on-demand audio platforms are springing up these days. It's unbelievable. And we're on pretty much most of them, if not all of them out, all the big ones at the very least. And of course, if you want to go above and beyond and get with us live here throughout the week, get on to the Plus. And of course, if you want to go above and beyond that, get the great pro Q&As we do every Tuesday, as well as Options Oddities every Friday. And then go to theoptionsinsider.com/pro. No matter how you listen live after the fact, keep hitting us up with those questions, those comments, those insights, those pearls of wisdom. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from on the program today. First, let's go out to the volatility mecca known as Texas. We are joined once again by the greasiest of meatballs, Mr. Mark Sebastian from OptionPit.com. Mr. Meatball, welcome back to Volatility Views, sir.
Always great to be here. I'm excited, and I'm excited to talk to our special guest that's forthcoming, guys. You guys are in for a treat.
And joining us, the aforementioned special guest holding down the MIAX hot seat this week, a newcomer to the program and indeed to the network. He is Jem KARSAN, the founder and senior managing partner at Kai Volatility Advisors. Jem, welcome to the Volatility Views program.
Thanks for having me, guys. Excited to be here.
And Jem, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the options and derivative space, as well as what it is you guys do at Kai Volatility Advisors.
Yeah, I got my start back in '98 in the pits in Chicago. CME, CBOE, equity index vol was kind of where I started and cut my teeth. Over time, grew several different operations. Eventually, my own business, Precision Capital, which was one of the biggest, if not the biggest, market maker in the S&P, as well as a bunch of other equity index products. But that was many moons ago. Sold that business in 2010 and started Volatility asset management firm. Really started in 2011, late 2011. That really started as a vol arb product, vol neutral kind of yield generation product. Eventually launched a long volatility product for institutional clients, and now also a dealer flow product, which is essentially tracking dealer flows and the effects on broad products. So 3 different products now, 3 hedge funds. Nice team here that we built, and raising a lot of money, and performance has been kind of great. So we're excited to kind of be here and kind of talk about what we see and what we're doing here.
All right, then let's get to it. It is time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review, the portion of the show where we break down the week that was, and indeed still is, from vol trading and trending and analysis and unusual activity, all sorts of perspectives. And coming into showtime here, it's been an interesting topsy-turvy week out there in the broad markets and indeed in the volatility space as well. Remember, coming into the week, we said, there's going to be a lot of focus on DC this week, a lot of dollars on the table, not just the debt ceiling, but spending and everything else. A lot of back and forth, a lot of consternation, a lot of hand-wringing down there in DC. And we saw a lot of turbulence as a result. We saw several days of sell-offs. We saw days where we were in the green, then we swung to the red, and now a day like today where we were coming in mostly in the red and now swinging into the green. Coming into showtime, we see pretty much most of the major indices pretty firmly in the green. The Dow leading the charge up about a full percent. The S&P up about 0.2%, and the NASDAQ up about 0.25%. So vol has been moving and shaking quite a bit yet again. Coming into showtime, we had the spikes over there at about a 22 even. That puts it up at almost exactly 4 points from where it was this time last week. VIX cash coming into showtime was at about a 21.5. That puts it up about 3 3/4 points from this time last week. VVIX, the vol of vol, a little bit south of its pandemic floor. Used to be around 120 was the floor for most of the pandemic era. Obviously, we've been below that quite a few times since then. And at about 116 right now, up about 7 points from where it was this time last week. So the table is set. Let's dive into it. Jem, this is your first time on the show, so we'll give you pride of place here. Obviously, a lot going on, a lot of back and forth in the world of volatility this week. Well, what was lighting up your tape over there at Kai Volatility Advisors this week, sir?
Yeah, so this has been actually an interesting week to kind of explore some of the flows that we talk about. I think from a macro perspective, you've had very high skew for some time now. From my experience and our data, it's very hard for markets to get quick down moves over like on a secular basis into high skew. One, because people are hedged. That's probably why the skew is high, right? That customers have been buying skew. Two, it represents opportunities for professional volatility traders. I'm sure Mark can speak to this as well, but term structure is steep and skew is steep. It represents a lot of opportunities to hedge at relatively low cost. People are broadly hedged. That also leads when skew is high to what we refer to as Vana and charm flows. So, second order Greek flows that essentially are due to high skew. Dealers are short put, long call in the indexes, broadly almost always, if not, but significantly so now and for the last several years. And as that skew kind of decays over time, that leads to kind of delta buyback. Also, as vol kind of comes into these declines with broad vol supply, you also see that buyback, and that's supportive. So what we've seen in the last several weeks is really a stair step down, which is what you'd expect given the fundamental bearish flows, but also the broad market vol structure and the flows that come off that, which are very supportive. So I think that's what you continue to see. Not a surprise here that, again, this morning we're kind of getting back some of those flows, beginning of month as well, end of quarter, beginning of quarter, there's been plenty of supportive flows. But the fundamental flows are bearish. Technically from outside the vol space, you're seeing a lot of rebalancing of over positioning and broad, structural bearish flows. So the vol space has actually been very supportive in this move. It's been a major kind of driver of why this thing hasn't been faster or more painful broadly. But it's important to note when you have these strong supportive flows and you then remove them, which tends to happen again, post in that week of expiration through main monthly expirations, which I think we're moving towards. That becomes a dangerous period where these vol flows are less supportive. So giving you an earful, a little probably more than you asked for, but this all makes sense in the context of the flows that we see. And I think there's reason to believe that these flows should continue through mid to late October, at which point if we can find a bottom and get a more kind of exhaustive kind of vol spike eventually in a place where vol flows are not supportive, we could maybe find a bottom. But that doesn't seem to be here yet, despite the fact that this week vol flows should continue to be very supportive.
Touching on a lot of different elements that we have hit on many times on this show over the past few months. Skew, of course, an ongoing topic of discussion. Those puts are quite juicy out there these days and have been for some time. And you're right, it does make it challenging in this environment for people who are looking and trying to pay these exorbitant rates of volatility for these puts. Trying to make money on that trade is a bit of a challenging perspective. Speaking of making money on trades, you mentioned earlier you have a variety of different irons in the fire over there at Kai, including a long vol product. This is an interesting time to be looking at long vol because, of course, we are vacillating all over the place these days. And we have joked many times here on the show, not so much this week, but prior to this week, when we had these quick vol spikes, we used to joke you had about 5 minutes to take it off before the vol just crashed right back down again and all your upside, all your long vol just was right back in the toilet again. So I'm curious for you guys over there at Kai, how do you approach the long vol trade these days? What is your MO? Are you using, delta hedge straddles? Are you going straight volatility products? And what are your thoughts on outside of this week where the upside is very short-lived? How do you go about capturing the upside for the long vol in those scenarios?
Yeah, so we don't trade a structured kind of product. It's very dynamic. We have two kind of primary sources of alpha in our long vol product. So to be clear, we have a long vol product, a vol neutral product, and then we have a dealer flow product, which is really kind of dynamic market directioning as well as vol. For the long vol product specifically, we have kind of two broad drivers of edge. One is our predictive dealer flow framework, which is essentially using these dealer flows that I talk about to really and the positioning by dealers to understand where and when we'll get support, both in terms of underlying flows as well as vol supply. That is predictive for not only the underlying but also the vol surface given underlying moves. So that's one of our kind of dynamic kind of positioning tools. The other one is really a more traditional relative value market making framework. Ours is a bit unique in that we deploy Barra factors within our relative value surface kind of modeling. So we are able to kind of see, based on large cap, small cap, aggregation, disaggregation, what's high and what's low across the domestic equity vol space. So we have two kind of sources of kind of unique edge there, I think. And based on those, we position dynamically. In this current environment, to kind of address your question more kind of on point, we have been into this decline short skew, which has been very profitable, and long vol. We're not the only ones, right? The key is how do you do that? We do that across term structure. So I think the biggest opportunities have been taking advantage of the term structure of skew, particularly in the indexes. And there've been a lot of profitable trades, given again our expectations for these bond and charm flows and the vol supply that we've seen relative to where the pricing was and continues to be. It's getting much more fair, but that has been a significant opportunity for us in terms of being long vol into this decline.
Yeah, Jem, couple of quick questions just for newer traders. Now, Vana is essentially gamma for volatility, right? That's the short answer for that. Why don't you charm? I've heard other words for that as well. I think we used to call it zeta. Do you want to explain what charm is to the audience? Because I'm sure they're very interested. They're not. One, that doesn't mean you need to go to Baltimore and get some new little things for your bracelet for your mom. It's actually something for options trading. Why don't you tell everybody a little bit about charm?
Yeah, so you mentioned beta. Beta officially, again, there people kind of use different terms, is the change in vol per time, okay? But charm is actually the change in delta per time of an options price. So per change in a day of time, per time period, it's the change in a delta of your options.
So it's a measure for like delta. We used to call it what? Delta drift. It's kind of a measure for that.
That's right.
Okay.
So, and I think you guys all know, like time is in our space is not linear, right? Like events have more time, and different times of the day have more time, right? But that having been said, I think you can still generally kind of predict that time moves forward and at some general pace, and that makes the charm flows that we see more predictable than maybe some of these other dynamics, right? And they're quite large. So they are one of the kind of cornerstones of being able to predict certain levels of flows at different periods. And I think that's an important component to our analysis.
I love the second order Greeks. We don't get a chance to get into them as often here on the network. Once in a while, we do it over there on our options bootcamp program. It seems like it terrifies the heck out of people when we do it, but always a fun conversation nonetheless. Mr. Meatball, same question for you, sir. It's been a very topsy-turvy week, both from a vol and from an overall market perspective. What has been lighting up the tape and the tape of your crazies over there in the land of the pit this week, sir?
Yeah, well, so Tuesday was definitely interesting when we got that nasty sell-off. I think the biggest trade of the week, and I know Jem went over this in Twitter a little bit, was a huge SPX collar that went up delta neutral. I believe that was a regular trade done by JP Morgan. But it definitely had some effect on things. And then I think yesterday what was really surprising, yesterday, Thursday, the 30th of September, one, it's the end of the quarter and the market is selling off and the VIX volatility cannot get off the mat. I pulled up my theoreticals and all of my out of the money puts are down and all of my out of the money calls were flat. They came in, and if you want to know why the VIX underperformed, they were slamming near dated skew yesterday, and that caused VIX underperform. And when they're slamming near dated skew, generally I interpret that as traders are cashing in some profits because they think that we're coming to an end. And so that was kind of what I was looking at yesterday. I'm not surprised that we're up 30 handles today. I would be less than shocked if we made a run at 43.50 as we're talking. And, the VIX probably is heading back below 20 as it tends to do. That's kind of what's on my radar.
All right, let's keep on rolling out into the land of the volatility futures. We've been saying before, we say it again. Matt said it on the show last week. All those incentive programs out there in Spike's land have been driving a lot of flow, and we saw that again this week. I'm sure they'll have more when they come on next week. They'll have more nuggets about how those incentive programs are playing out over there in terms of day-to-day volume, because I know the numbers have been fairly strong out there across the board. Heading on out to the VIX futures coming into showtime, we saw, surprise, the front portion of that curve, the ever-evolving front portion of the curve, up a wee bit. Coming into showtime, we had the OCC future up not quite 2 points, about 1.9 points or so, and the no future is up about 1.25 points or so. Of course, wait a few minutes, and that's going to evolve. Jem, I'm curious for you, how big of a factor is the volatility term structure in your analysis over there at Kai A? And then B, what are your thoughts on what we're seeing out there this week, sir?
So the term structure is important. generally speaking, our view is that the skew is more important. The amount of skew there is and the term structure of the skew is what kind of drives that imbalance in delta effects. So that tends to be a bigger driver. I will agree with Mark that we, 100%, that skew coming down like it did yesterday into that decline and vol declining into the decline is usually a very, very strong indicator for the next several days, if not week, of kind of that they're drawing a line, and the market's likely to go higher. It's just too easy to hedge in that environment, right? That said, it has some work to do past next week to find kind of the support it needs after it, like I mentioned. Term structure not as important, but again, that skew coming down like it has, and vol, fixed strike vol, I want to be clear, coming down on the option side was a pretty strong indicator, even that kind of what felt like a scary move down yesterday, to giving us the confidence to be longer underlying today, as well as shorter vol. Why is the vol coming down into the decline? Broadly, again, people are hedged. That JP Morgan trade is a massive amount of vol. What people were short in term structure in the SPX and vol writ large is DSON back. They were short. They got that all back, and now they're long the stuff in front too, right? And people are trying to get out. So when that vol is oversupplied, the market has a hard time going lower. And again, these vol flows from the skew side and the vol side, as I mentioned, have been very supportive, even into a decline. Easy to be short vol and still make money into a decline. That's too easy. That's not going to cause the stress this market ultimately needs. I would put that on its head, though, and again, the second order effect. You guys are students of vol history. Generally the bigger declines don't come with vol spikes as much, right? March of 2020 is an exception. I think that COVID and whatnot is a story. But if you look at August 15, right, that was not that big yuan devaluation, not that big actual directional move, big vol event. Everybody long vol after that. We actually got a much bigger decline in first, more than 10% decline in February, Jan-Feb 16, right? Oil at 20. That was a stair step vol crush, skew crush move. Took a lot longer for it to bottom. You look at February 18, right? XIV, Volpocalypse, big vol move, not a big directional move, really. Everybody long vol after that. You get chop down off to D's 18, almost 20% down. Vol didn't really perform there.
Jim, question for you.
Decline can happen with a vol decline. It's just going to be stair steps if it does, and it's harder for markets to find a bottom when vol actually doesn't bottom because people's hedges aren't actually protecting them.
Yeah, Jim, question for you. I got a couple of quick ones. My interpret is part of the reason for the way the market pattern that we've seen with kind of a couple of rips lower and explode higher is that, we've been basically hypothesizing that it's because the market is so hedged. You actually see the flows, so you can actually tell us. And two, do you think that relates to the fact that the VIX has been way overpriced for a year now? And in order for what would we need in order to really get a shakeout? I've been arguing we actually need some of these hedgers to go away and get the VIX back to maybe 12 or 13. Would maybe see some players in VIX again. VIX volume is dying. And two, when you have people caught a little flat-footed, that's where you can actually get some sell-offs. So I know that's a bunch of questions for you, but I'd love to hear your thoughts.
Yeah, it's good to talk to somebody who gets it. Absolutely, Mark. You're right on a couple different perspectives there, but I'll drill down a little bit. You have a $450 trillion long asset world, about 180 trillion in global equities, about 80 trillion local domestic. Okay, we have about $1 trillion in hedge out there, right? So when people are increasing their hedges and worried about valuations, has a dramatic effect, right? There's such an imbalance here. And it really is a massive supply and demand imbalance, right? That causes, 95th percentile VRP, 95th percentile skew, et cetera, right? But it also makes a lot more people hedged, right? And a lot more people able to kind of take off hedges as the market declines, right? And that is actually 100% correct, that people are hedged, and that's why skew is high, and that's why VRP is high. But ironically, that's also what supports the market, right? And makes it harder for the market to decline. So, it's also why generally after big market declines and people start to hedge, selling vol tends to be a good strategy, right? And also after it hasn't happened for a while and people give up on hedging because it's been a losing endeavor, right? Where you get ultimately kind of, a ability to get a bigger kind of spike, right? And again, why I just kind of touched on August 15 versus Feb 16, early 18 versus late 18, right? And now we're talking about March 20, 20. And here we are, kind of everybody wants to hedge. I get so many calls about long vol, right? It's pretty crazy. And I have to kind of, and I don't want to talk people out of it, but I also want to let them know that like sometimes long vol is not the right way to protect against a decline, right? It's a great product that we have, but there are times when the world is hedged when it's not optimal for hedging your downside. So I would agree with your statement there, and we broadly need people to hedge less. Vol is not working into this decline, right? It's not.
No, it's not.
It's not working, and that's good for a market decline. Makes it more likely for people to not hedge as much going forward, right? To the extent that this thing can decline another, 5, 10, 15, whatever the percentage is, and vol does not work, right? That will be what you need to happen to eventually clear the way for a real decline. That is how this thing works. The second order move, right, after a big decline is when the vol doesn't work, when people stop hedging is what ultimately leads to the bang, in my view. Again, it's not as easy and it's not just a simple function like that. There's more to it, but skew is declining. Skew is not working. Vol is declining into a drop, not working. If this continues into a major kind of another 5-10% decline, well, what do you think the reaction is from all those long vol players who, were trying to hedge that move and got hurt on the vol and their stock? So, but we're watching the flows directly. We're not just kind of looking at this correlation and what happens broadly. If we start to see those flows actually dampening into the next rally, skew and vol kind of having kind of less extreme positioning, I think we can then pave the road for something bigger. But doesn't mean we're not going to decline stock-wise, right? It's just that vol is unlikely to, for a while here, to continue to be the thing that you want it to be.
I think we have a title for our episode here. We need people to hedge less. I like that. I like that sentiment getting out there in the marketplace. Mr. Mark, if you have any thoughts along those lines, also on the volatility surface, have at it. And then you both mentioned that SPX collar. If you want to hit people really quickly with the strikes and what was involved, have at it, sir.
I have the strikes here, if anybody, 34.80, 41.35, 45.05. So that was the structure. They tied it to a 41.5 cent quarterly call in the money, which then decayed off, right, to give them end of the day, end of the quarter, new hedge, right? The way it's structured is 5% out of the money, 20% out of the money. They always choose that put spread, and then they write the call out of the money to make it premium neutral. So that's the pre-prescribed structure. A lot of the articles in Bloomberg and Yahoo Finance, you think they'd know better, was all about how this trader is coming in and he's betting on X, Y, and Z, and he must be bearish. Like, no, it's just a pre-prescribed trade that happens every quarter. But it does matter. It does compress vol and have an effect on the term structure of skew. But I'll hop out there and let everybody else kind of.
To make that trade premium neutral, you got to do some digging these days to pay for that put. I'm surprised they don't do the put spread on a ratio or something along those lines, because there's so much vol to spread away.
Yeah, the call gets closer to at the money all the time.
Yeah, you're pretty much selling an at the money call almost at that these days out there. Interesting stuff. Mr. Mark, if you have any other thoughts on that collar, how interesting of a position that is right now, as well as the evolution we're seeing out there in the VIX futures term structure, have at it, sir.
The last two times we've been able to get into a little bit of a short backwardation period, we've not been able to hold it, and that's been a sign where the market was bought. And it's like clockwork. That term structure goes slightly backward. The hedgers, the guys that are long hedges, start dumping their puts. Market finds a bottom, and we rally. I think the futures curve. You look past December, and there's a lot to be interested in getting short vol on.
Indeed. Let's keep on rolling out here to the land of all the fun listed volatility products. We'll start out there in Spike's land. The OI pretty much lining up similar to what it was out there last week. Your top positions are going to be those 2 3-ways still. You've got that 26-32 half vertical against the 23 put all October there. That's about 1,400 each of those, followed by about 1,000 each of the 23-30 vertical against the 17 put. So 2 pretty sizable 3-ways dominating the tape out there in Spike's options land. Going out to VIX options land, you might think, given all the back and forth we've seen out there in the market, and again, back and forth today, we'd see a little bit more paper on the tape, but your ADV is actually pretty much unched coming into showtimes, up about 1,000 contracts from where it was this time last week. So for all that back and forth out there, not a heck of a lot of change from an overall volume perspective. And today is another example of that, only about 225,000 contracts on the tape right now. Let's go out, see what the size positions are out there in VIX options this week. It cost you about 133,000 contracts to break into the top 10. That's not a ton, but it's not nothing either. It's kind of right in the middle of that range there. That gets you to our first of 3 calls, only 3 calls in the top 10. So read into that what you will out there, listeners. 133,000 of the NOV 20s. Get a lot more NOV on the board this week. Number 9, 134,000 of the October 19 puts. Number 8, 136,000 of the NOV 60s. My favorite contract on the board still. Number 7, 137,000 of the Oct 20 puts. Number 6, 167,000 of the October 16 puts. Number 5, back to November, 174,000 of the November 17 puts. Number 4, our third and final call in the top 10 this week, 193,000 of the Oct 50s. Number 3, 195,000 of the October 18 puts. Number 2, 232,000 of the October 14 puts. And rounding out our top 10 this week, not even 300K, 295,000 of the October 17 puts. Total of about 7.4 million contracts open out there right now in VIX land, about 4.3 million on the calls and about 3.1 million on the puts. Mr. Jem, I know you mostly play out there in the SPX space and watching all that structure over there, but do you watch the listed volatility products? And if so, what are your thoughts on the VIX options landscape these days, sir?
Yeah, I mean, I obviously watch the VIX landscape, more feed, indicators in our broader models. I would say that, look, the vol of vol is kind of the one piece of convexity. It's the one thing that if you can own that and this is not new news to anybody, own that to kind of monetize kind of that skew in the S&P, right? That's been a great trade and will continue to be. It's driven, obviously, high, steep skew in the VIX as well. But I think that the cost of that skew in the VIX and that convexity is still much, much cheaper relative to the convexity you get relative to the skew in the S&P and the indexes there. So that's more kind of what we look at, the kind of the vol and the vol term, the VIX term structure and skew. But once you get to the ETNs, and we try not to play too much in that space. I'll leave that to a couple of the other guys.
Let's break down a real quick rundown of some of the action that we saw this week. And I put action in air quotes because there really wasn't a ton of it. You'll see by some of these numbers really quickly, listeners, why the ADV hasn't really budged since last week. Like I said, today, about 225,000 contracts on the tape are our top 5 most active out there today. Number 1, about 25,000 of the October 26s. Number 2, about 24,000 of the October 37 halves. Number 3, 12,000, almost 13,000 of the Oct 30s. Number 4, about 10,000 of the Oct 20 puts. And rounding out the top 5 today, about 9,500 of the Jan 21 puts. Interesting smattering there on a pretty light volume day. Yesterday, a little bit more paper, not a ton, 319,000 contracts on the tape. Looks like the big trade was a put vertical, about 16,000 of the OCK 2018 put vertical going up, followed by number 3, 15,000 of the November 17 puts, number 4, 14,000 of the OCK 26s, and rounding out the top 5 on Thursday, 12,000 of the OCK 16 puts. Wednesday, even less paper, 245,000. I think, again, you could see why the ADV hasn't really moved. The most active contract on Wednesday was the OCK 40s, interestingly enough. Nearly 19,000 of those going up on Wednesday, followed by the OCK 30s, 13,000 of those. Number 3, the October 18 puts, 13,000 of those as well. Number 4, the October 20 puts with about 12,000. And rounding out the top 5 most actives on Wednesday, almost 11,000 of the October 17 puts. Tuesday was the most active day of the week. And again, in relative terms, not a heck of a lot, only 579,000 contracts on the tape. Going back to the conversation we had earlier about volatility, long vol isn't really working right now. Well, that's being reflected in some of this paper out there. We saw some pretty dramatic moves out there this week, and yet the volume not really commensurate with that. Only 579,000 contracts on the tape for Tuesday. The most active contract, nearly 50,000, about 49,000 of the October 20 puts, followed by number 2, the October 19 puts, 36,000 of those. Number 3, the October 18 puts, 27,000. Number 4, the No 17 puts, yet again, 25,000 of those. And rounding out the top 5 on Tuesday, we got about almost 21,000 of the October 16 puts. Then we get to Monday, which is pretty much anemic by any definition, 128,000. Let's just do a top 3 for Monday. Not a lot of paper going up out there. The October 19, 18, and 17 puts are pretty much all that traded. 16,000, 11,000, and 11,000 respectively of each of those. So a pretty light week. Mr. Meatball, again, not a ton of paper lighting things up in the land of VIX options, but what, if anything, was catching your eye out there in the eyes of your crazies in the pit chat this week, sir?
Yeah, I mean, this was a clear example of vol just not working this week. That's why nobody was coming after it. If you tried to go long, just go long volatility to hedge a portfolio, it didn't work. And again, because one, the spread between the VIX and the VIX futures was cataclysmically wide, and the option vol was already pretty high. I'm looking at some of the downside on these big, huge up days. The only thing we really see are puts being traded. They're buying November and October puts. Everyone's playing the fade on the VIX side. Another case where we need, in order for these volumes to pick up, we need the VIX get back to 12 or 13. If I'm the SIBO and I'm looking at SPX, I'm a happy camper because the volume's going way up. But if I'm looking at VIX, I'm starting to get worried because when we have the VIX in the 20s and option volume is less than 400,000 contracts, less than 350,000 contracts, that should be alarming the people running the show over there.
Yeah, it's alarming for us doing this show here. Not a lot of paper to sink our teeth into this week. Before we get into the ever-eroding products that you folks all love, your VXXs and your UVXYs, Mr. Jem, I'm curious for you. This is obviously a very hot aspect of the volatility space for a certain segment of the audience. They love to come in and fade these VXXs and these UVXYs pretty much to high heaven. And for the most part, these products have rewarded them. It has worked out. What are your thoughts on this side of the space and the folks who are just flocking into the dark side and products like VXX and UVXY, Jim?
Yeah, I mean, much better to short them than to try and de-long them, particularly in this dynamic that I've talked about, where people are broadly hedged, right, and where VRP is in skew or in the 95th percentile or 90th plus, right? Again, there's reason to believe that you'll continue to find support. Now, short term, again, until this market finds more of a footing, you're going to continue to get spikes in between. But I think for the time being, those are spikes to be sold. Now, eventually, that's going to be. I think we're much bigger. We're talking the next year. If you continue to play that kind of blindly in the next year or so, once we get this lack of hedging more, like this market's got some major issues and a major tail on it for lots of reasons, mostly tied to liquidity and exchange, and interest rates than anything. But there's a short window here where, the getting is good and it should continue to be good for a bit. But I would be very, very hesitant and very watchful for what will eventually, be another blowout in that space. I think we're probably still 3 to 9 months away plus from that.
Now let's get on out there, see what you folks have been up to in your favorite products to fade. Let's go out to VXX first. Coming into showtime, it was at about a 27 and a quarter. That puts it up a little over 2, about 2.1 points or so. It has given up about half a point almost since the show even started as well. So it is giving up all that upside and probably moving back to the dark side, maybe even by the end of the day. We'll see. It might be a bit of a bridge too far, but crazier things have happened out there. In terms of ADV, that actually has ticked up, unlike our friend VIX. There has been some paper out here in VXX. That's up to about 287,000. That's up about 21,000. So pretty robust for VXX. And today looking pretty decent as well. 186,000 contracts on the tape. Let's just do a top 5 out here because we're kind of coming up against it. Number 5, 18,000 of our only pre-split adjusted VXX1 left in the top 5. That's nice to see. It's the Jan 12 puts. Number 4, 18,000 as well of the Nove 18 puts. Number 3, 20,000 of the October 28s. Number 2, 27, almost 28,000 of the SEP 54 calls. That's back to our friend out there who loves to sell the upside in VXX like it's going out of style. Though he has mitigated from the 70 to 75 strike down to the 54 strike, apparently. Getting a little bit better juice, I guess, on that strike this week. And number 1 out there, 32,000, almost 500 of the October 25 puts. In terms of action, like we said, not a ton on the tape out there today. Decent paper, though, 186,000 contracts. The most active contract out here was about 13,000 today of the October. And again, these are all pretty much going away today, listeners. The October 27 puts, followed by about half that, about 6,000 of the October 28 puts. Then we have about 4,000 of the October, the only October expiring next week, the October 8th, 24 puts, then another 4,000 as well. Of the 26 and 27 half puts, both in October, both expiring today, both going up for about 4,000 contracts. Mr. Mark, any thoughts out there on your second favorite ever eroding product, VXX?
Yeah, again, it did nothing when we got that big vol push. VXX did nothing, barely rallied, and UVXY the same. Futures don't move, these don't move. So right now we're in a weird spot, I'm gonna probably set up a UVXY fade. I actually did buy some UVXY puts yesterday. It was a little early. Wish I'd have bought them this morning, but what are you going to do?
Timing can't always be 100% out there, especially in a product like UVXY that's just going to whip all over the place minute by minute out there. Speaking of UVXY, let's get to that one as well. Coming into showtime, it was at about a 23 3/4. I'm sure it has given back some of that now as well. Let's see, about 23 1/4, giving up about a half a point over the course of the show here. So it was up about 2 3/4, now up about 2 1/4. From last week. ADV ticking up pretty strong out there as well, up to about 181,000, up nearly 20,000 contracts from this time last week. And today, again, respectable paper, 171,000 contracts on the tape. Let's do another top 5 out here really quickly because these are obviously much smaller. Number 5, the OCT 21 puts, about 6,700 of those, followed by number 4, about 7,000 of the going out today, the October 1st 24 calls. Probably not going to happen on those, but again, we shall see. The day is young. Number 3, 7,000 of the OCT 20 puts also going out today. So October 1st. Then we go out to our only UVXY1 here, about 9,000 of the Jan 1 puts. And then rounding out the top 10 here today, about 13,500 of the Jan 75 calls. Interesting. I wonder if that's our same friend who's discovered the upside in VXX, also coming to play in UVXY. In terms of action out there today, who's playing out there? A decent paper, about 11,000 of the October 23 puts is your number 1 most active contract out there, followed by number 2, pretty much exactly 10,000 of the October expiring next week. 21 puts. Number 3, about 8,000 of the October 24 puts. Number 4, about 7,000 of the OCT 24 calls. And rounding out the top 5 most actives today, the October, again, all these except for the aforementioned one expiring next week, all these expiring today. The October 25 calls, about 6,000 of these as well. Mr. Meatball, you already mentioned your UVXY puts. Let's look really quickly on the earnings vol front. Really quickly, we had some dregs of the season rolling in this week. Actually had, though, some green on the screen, which is interesting, showing a little bit of a lot of vol outperformance this week, which is something we have not seen for quite a while and was starting to get indicated by our earnings move and earnings season reports coming out of ORADs that we're starting to see a little bit more of that outperformance. Is that on the docket again? I encourage you to check out our Advisors Options show. I got into that with Matt on that show just earlier this week. It'll be hitting the network soon, and you could hear what he thinks for himself. But spoiler alert, he is expecting a little bit more juice coming up for the next season. Let's look really quickly at a couple of big ones that popped off this week. We had good old Bed Bath & Beyond yesterday before the bell. They were pricing in, let's see, they're at about 22.25 going into their announcement. They're pricing in 12%. They delivered 25.3%, listeners. It's very rare that we see a 2x outperformance out there these days, but that's exactly what we saw. CarMax, same deal, right around 146.5 going into their announcement. They were also before the bell yesterday, and they were pricing in 5.3%. They delivered over 10, almost 11%, 10.8%. So two names at the tail end of the season, pretty much doubling their earnings vol expectation. If anything, it's usually been the opposite. If you've been listening to this show or any of our shows for the better part of the last year and a half since the pandemic began, you know that earnings volatility is a place where money has gone to die. It's just been annihilated. This is the first season where we've had something coming close to 100% return on your capital again, up to about 86%. You're still losing money, but a heck of a lot less than you were, let's say, in the middle of last year when it was in the 50-odd%. So the last 2 weeks, I should say, of the season are both turning green here. Outperformance, 107% and 100%. These last 2 names we just talked about, both outperforming dramatically. Is this going to set the tone for the next cycle? We shall see, but so far, at least, the early indicators are intriguing. You know what's always intriguing? It's your mail. So let's get to it. A little bit of the old volatility voicemail.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Voicemail, the portion of the show where you folks take the reins, your questions, your comments. You know, you folks out there in the secret club always get bumped to the top of the list, just like Nichols here. He's listening live. Says, great show, loving it. Well, we're right back at you. We're having fun here as well, Mr. Nichols. He says, maybe we should add an SPX options rundown to the show each week going forward. I know that I would tune in. You know, we have people have asked that before, and we have toyed with it. We touched on it today. Usually when there's interesting prints, we will get into it. But as you can see, there are a lot of products, a lot of analysis, a lot of things to squeeze. The show's only an hour at the end of the day. It's not 2 or 3 hours. It's not every day. It's once a week, 1 hour. So if we started adding SPX and everything else to it, you know, it would not fit. It just there's so much paper in SPX alone. So when there are interesting trades like this collar we talked about today that are kind of informative to what else is going on out there, and maybe it's a somewhat light week in some of the other products, sure, we love to break it down. But outside of that, it's just like trying to analyze the individual droplets of the hurricane. There's so much paper going up out there in the S, and we have limited time here on the show. Let's go out to this next question here. I like this one from Selfie T. Selfie T says, what are your thoughts on the variance swap market? Is there anything there that regular vol option traders should pay attention to? Well, first off, Selfie T, listening to a show like this, I would not demean yourself by calling you regular. You're obviously a very discerning intellectual individual. But that aside, let's start with Jem. Jem, I know you watch a lot of different indicators out there in terms of the vol space. A, what are your thoughts? He wants to know on the variance swap market. And B, do you think there's anything that the quote unquote regular vol options traders should pay attention to out there, sir?
Yeah, I mean, a huge component of, still a very vibrant, important part of the market. If you're not tuned into it, you're missing a lot of kind of big picture kind of vol supply. Yeah, I mean, obviously the most important component, the most predictive component of flow is just pure vol variance, and understanding where that is in terms of positioning is critical. So, I mean, yes, the answer is absolutely, but obviously harder for your kind of, I don't know what you define as regular, but your retail kind of investor to get that flow information if you're not hooked into your prime and the major primes that are trading it. So.
Yeah, it's a challenge, obviously, for a show like this, too. We do some color from that space every now and then, but getting reliable, interesting, two-sided flow insight on what's going up out there, sometimes it is hard to parse that information. Mr. Meatball, any thoughts here from Selfie T on the variance swap market and its relevance or perhaps lack thereof for quote unquote regular vol traders.
Yeah, it's important. You can usually, it's tough to gauge for retail folk because, again, you're not seeing all the desk flow. But you can generally see that there's been some big variance stuff in SPX when you see what's called a cash spread go up. Or you'll sometimes see them try and rebuild it with a bunch of laddered trades in VIX as well. But, other than that effect, it doesn't have a huge effect on most of your guys' trading. But if you do hear about it, about a massive one and see some flow, then, it's worth paying attention to.
Actually, I'll jump in. To Mark's point, I think this is actually important. It's like those are first order effects. Those structured products, whether they're auto callables or cliquettes, right? Those have major effects on bank flows. But ultimately, banks are hedging that in the SPX or other similar markets. So even though you may not see the first order effects, you do get the second order effects like on the tape usually. So it's an edge if you can see it first, right, to know kind of where things are going. But ultimately, most of that does get shown in price and trades on the vanilla option side as well.
Exactly. That all ends up filtering out in the listed products at the end of the day. But now, Jem, I hope they prepared you because it's about to get difficult. It's about to get dangerous. It is time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. You know what time it is, the most difficult, most dangerous portion of the show where we attempt to wrestle with the volatility gods and figure out what they have in store for us for the coming week. And last week, it actually looks like we had some hits out here, some actually scary ones out here. Mr. Meatball on the show last week, you were 21-21. Matt from MIAX was actually 21.5. I was feeling a little less vol. I was at 18 double. Not looking too good for me out there. Because coming into Showtime, both VIX and Spikes was at 21.25, which would have been almost exactly a bullseye for you, Mr. Mark. It is now at 21.37, but VIX is still hanging out around 21.25. You were at 21.21, Mr. Meatball. So well done. That's your first bullseye in some time, sir. Well done.
Well, the issue is that I only go high on VIX when I'm betting against my book. So it's not such a great win for me.
I was going to say, that means you probably are a little bit in the red this week, but we won't talk about that here on the show. A lot of our listeners were all over the place. 16.5 for Luigi. 22-22 for Unlimited. We were there until we weren't. Frank was at 19.5. Options Queen, 18 to the dark side with me. No love there. JJ, 1982, all over the place. Athena was at a 22. That's a new name. I like that one. Greek goddess there. She was closer. Super VIX, 1888. JBC, God, way up there. 26. Munster, 1640. Nichols, looking pretty good, Nichols, until you weren't. 2190. And now we're at 21.25. So you're within a point at least, but no joy. So, Mr. Mark, you are our winner chicken dinner this week. I'll let you choose who goes first, sir. Who do you want to go first?
Let's let our guest. I mean, he's here on his own time and dime, and we appreciate it.
He paid a dime to come on? Wow, that's impressive. I'll have to collect my dime after the show. Mr. Jem, you have been given the dubious honor of going first, sir. What are you feeling for this time next week from a VIX perspective, sir?
So, to Mark Sebastian's earlier point, the reduction in skew and vol is short-term supportive. There's also very strong, this is the week prior to expiration week that we're going into, the strongest period for these kind of charm and Vana flows coming off a relatively elevated vol. I'd expect it to continue to trend lower and for the market to kind of try and shake out shorts to the upside. So 17.5 would be my prediction for AUK 11. That said, if we were to go 2 weeks, I would say you're looking at a higher VIX than we have now after that. So 23 up to even 28, it will hit again before this thing is done.
Wow.
Interesting. So we're flirting with both sides of the strangle there, sir, to the downside and to the upside over the course of the next couple of weeks. I like that. All right, Mr. Meatball, I'll let you go last because I know you like to go last and cart me aggressively. So we got Jem at a 17.5. He's feeling some downside. I was feeling some downside last week, and it didn't work out too well for me here on the book. But you know what? I don't usually do this, but I kind of like where I was last week. I'll just adjust it ever so slightly. I'm going to say 18.5. So I'll be a point higher than Mr. Jem. So Mr. Meatball, you got a whole point to dive into in between, or you want to go elsewhere, sir? What are you feeling for next week?
Yet again, I need to bet against my book. And so I'm going to say 24-24.
24. Wow. All right. Getting all of it. Man, we have quite the ride market for you listeners. 17.5 on the dark side, 24-24 on the upside. Unfortunately, that music means we have come to the end of another epic sojourn through the world of volatility. And of course, epic job all around. I know you got to hop off Mr. Meatball really quickly. So before you go, if folks want to check out what's cooking in the land of the pits, where should they go? What should they do, sir?
Yeah, head over to optionpit.com and read my VIX blog. The VIX Edge comes out every day.
There you go, optionpit.com. Check out the VIX Edge. And Jem, well done for your first time here in the MIAX hot seat, first time on the network. Anyone who comes on, talks about second order Greeks, you're welcome back anytime, sir.
Awesome. Thanks for having me. Happy to come back.
And if folks want to learn more about what you're working on over there at Kai Volatility Buyers, maybe they want to ask you some questions directly, where should they go? What should they do?
Yeah, IR at kaivolatility.com is the email to hit us up at. And obviously, at jam_croissant is my handle on Twitter. Pretty active on Twitter. Feel free to hit me with a DM there. And kaivolatility.com is our website.
So you're a big French baked goods fan then?
Yeah, COVID did a lot of strange things to people. Turned me into a digital paste.
Hey, to each their own. Check them out over there, Kai Volatility Advisors. And as you mentioned, at jam, JAM_croissant. Over there on Twitter. He tweets once or twice, so you may want to check that one out. And of course, you know where to go to learn more about all things spikes, MIAXoptions.com/spikes. Head on over there. You get the historical data. You get, of course, the releases for all the updates, what's going on with the futures and new options products, as well as, of course, a link to a great show called Volatility Views. What more, I ask you, could you possibly ask for from a volatility-oriented destination? MIAXoptions.com/spikes. And on behalf of everybody over there in the land of MIAX, and of course, Jem and the Meatball, and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing. Remember, this concludes our regular broadcast week, but if you're in our secret club, all of our pro members get to come back in about exactly an hour. We're going to break down the week that was from an unusual options activity perspective on Options Oddity. Stay tuned for that. Should be a great time. If you're not part of the secret club yet, theoptionsider.com/pro is the place to go to learn more. And we'll see you back here next week on the option block, kicking things off on Monday, all the way through to another Friday, another episode of Volatility Views. We'll see you then.
Volatility Views is brought to you by MIAX, one of the fastest, most efficient trading platforms in the world. MIAX is proud to bring you Spikes Volatility products. Spikes options and futures are traded on the Spikes Volatility Index, Spike, offering pinpoint accuracy, radically faster dissemination, and a highly transparent settlement auction, all for ultra-low exchange fees. It's volatility reimagined. Learn more about Spikes at MIAXoptions.com/spikes. Options and futures involve risk and are not suitable for all investors. The statements made are provided for informational purposes only and should not be relied on for financial or legal advice. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.